Good morning.
It's a positive day, and I'm very energetic now seeing all these great people here. And we're all driven by one thing, which is love for our city, our country, and love to be global citizens and city changers. The event is, the title is VCs for Good, but I think we are in a country that we don't accept good. So let's call it VCs for Great, and we need to be great. And this is the best time that we introduce such initiatives. Recently, the government of the UAE announced that by 2050 we will be a carbon neutral country. And recently, Dubai government, led by Sheikh Hamdan bin Mohammed, announced that the initiative of Dubai Can. So let's say, yes, Dubai can, UAE can, and we all can, and we need to all be part of this. The leading the United Nations The City We Need campaign here in the Middle East, I'm very privileged today to tell you a little bit about why we're doing this. So this is a continuation, it's not an event, it's a movement. So please underline that. It's not an event, it's a movement. And movement starts from every one of us. So we go back home and we take an item that this is what we need to change. In our office, in our city, in our home, we need to change something. Looking at VCs and history of VCs, and I don't want to take time, Deepak, but I really found very interesting stuff about the history of VCs. So in 13th century, when Marco Polo traded between East and West, he actually used VCs at that time, in not the real name, but in an old format, where he got funded by wealthy merchants from Venice. And he gave them 70% and he took 30%. So the impact he actually added is he linked the East and West, and he introduced the paper money to Europe, and he became ambassador of the Asia part. So VC was a means for good at that time, connecting the East and West. Looking at 1946, the first modern VC was introduced in the US. It came after the Second World War. And the idea is that to invest in technologies that will help revive the globe after the Second World War. So today we talk about something similar, right? After 2 years of COVID, 5 million people died, 400 million people got infected if you're following up with the numbers. And what's even worse is that adding to the $2.5 trillion of funding gap to SDGs, we have on the top of that $1.7 trillion just because of COVID. So it's the time to be talking about funding SDGs and innovative ways of funding SDGs. So VCs have been always a means of good. 8 out of 10 largest corporations in the world have got VCs backing, like Alibaba, Amazon, Apple, Facebook. All these companies got VCs backing. And about 39% of companies and IPOs from 1980 to 2020 got VCs backing. So we don't say that VC has not done good. No, they have done great things. And now it's the time to take it to the next level. VCs invested in 3% of VCs went to female-led companies. No, it's the time now to rethink that. We need to invest more in gender equality. This is part of SDGs.
Investing in ESG factors has also become important for VCs. I think there's a clear link between the economic outcome and ESG factors. And I think there's some study done by Business and Sustainable Development Council, which says there's a total opportunity of $12 trillion in companies which are trying to solve the ESG-related goals. So agriculture, education, well-being, technology. And that's where I'm sure VCs are also looking at this market opportunity. There's a clear indication that the financial returns that they are aiming for can also be achieved combining them with the economic and social impact. The VC investment into sustainability is growing. I think some statistics say that in the first half of 2021, the investment grew by 61% over the previous half of 2020, which was itself a very big number. I think obviously COVID has been a catalyst for moving this money.
Education was one of the most important pillars of achieving SDG goals. When we fast track to look at some of the reports that indicated when, or like how quickly or where are we on track to achieve these SDG goals in 2030, by 2030. So we started thinking, how can we be creative and what needs to happen in the space? How can we start accelerating education and the impact of education and the journey towards achieving these SDG goals? And we realized that education as being the important pillar is not enough. It's not fast enough. Bricks and mortar, physical teacher-student interaction, everything associated with that is not fast enough. You cannot achieve the reality check that is we're not going to be on track to achieve these goals. So the one area that we felt that would be very impactful is EdTech. EdTech being a lot faster, more scalable, boundaryless, and one teacher versus 10,000 students, easily adopted. Of course, it's got its limitations when it comes to technology, etc. But that would be essentially the most critical component of trying to meet the journey or improve and enhance the sustainability goals. Within EdTech, now what do? Do we go down the grants? Do we go down the accelerators incubator path? Or do we go down the venture capital funds that are in place? We decided to pick a venture capital studio, which is the venture studios, as Romana was alluding, is a phenomenal way to work with founders that can help scale and solve problems and disrupt major problems, major challenges within the education space by hand-holding them and taking them through the whole journey of feeding them with capital, giving them the support shared services that they need, that they don't know how to run with. And that was kind of our summary from working with entrepreneurs and founders in the region. While they have brilliant ideas, they're not able to scale them up fast enough. And many of them just, unfortunately, take the wrong turn into the universe and never make it into a successful startup.
The model that we operate is that when a new investor wants to invest into a new sector, the government says, okay, when we invest, we'll take back just 1x of our money, and the rest will allow you to supercharge the rest of the investors, which means that there is more incentive for the higher risk. And if we could operate and bring in models like that, that would also support us to be able to achieve the goals faster.
My next question to you, Yusuf, you've given how many 140 startups the grants between 100,000 to 500,000. What's been the journey, and have you seen the tractions? Some examples.
Maybe to reflect a little bit, I personally don't think that the VCs and the VC model is going to save the day. I think it's a part of it. I think VCs are not applicable at every level of investment. We gave out grants, and there were some people we said no to because they fall so much on the left, I'm not going to say right or left, but on the extreme of being almost a charitable establishment, a charitable effort. And guess what? To solve the SDGs, we're going to need a lot of charitable efforts. You can't solve many problems by creating an enterprise that's going to solve for that. It's going to charge what? There are people who are just too poor to pay for something, whether it's education or health. So I like to begin with that, right? And for us, what we've learned in this process, right, is that yes, grants is amazing. They are amazing because they allow the startup to buy time. Startups fail when they talk to VCs too early, when they get into a deal that doesn't work for them. We've had several that closed down because they got too excited and got VC money when they were not ready, right? So the grant, as a mechanism at the right stage, allows them to get better at what they do, right? Figure out what is that they're really trying to solve and how they do it sustainably before getting to the VC level. So we always, I think most of us here talk about that linear, right, between bootlegging, like using all of your credit cards to start your startup, then somewhere along the line an angel investor, then somewhere along the line a VC, right? It does kind of work that way, and I think we've experienced a lot of that. So again, we are in the process of trying to become a VC, right, in a way, so that we can deploy more capital in a more sustainable way. Grants is beautiful. It just never comes back. That's the problem with it. It goes. It doesn't come back. It goes forever, right? And it doesn't always do good. We've probably given grants to organizations that don't deserve it. Let me correct that. That probably wasn't the best financing mechanism for them. They probably should have gotten debt, right? But we were very excited with the expo. Right? We wanted to get everybody in, and so we gave them some grants. I speak very lightly about this, but we were using public money, right? So there's a lot of seriousness behind what we did. But I'll keep it as that. I think VCs and the VC funding mechanism and its expectations, right, are not always gonna be the solution, right, for the entrepreneurs that the Ramona talks about. So I'm very careful about that because we can hurt their journey.
I know both Romana and Basim want to intervene, but I have a point that I want to mention, and from my own experience, that all the social and environmental problems can be only solved if you bring some kind of monetization around that. I think the VCs definitely want to look at economic and social impact, but at the same time make profits for the investors. So unless you combine this 3 or 4 different aspects, this sector may not grow. So only non-NGOs and non-profit organizations may not achieve the objective. You want to say something?
Sorry, I was just going to say, absolutely. I think it's an entire ecosystem, and I think we all accept that. But let me hypothesize that if we fixed and we had more VCs, and let's say if we say only 11% of VCs are run or operated or have any female in them, if we fix that, okay, at the top level, which means that we've got more women who are investing, which changes the gender lens, the bias with which we're making investments, we see from statistics that women tend to favor and support to bring in other more female employees, and actually investments with more diversity tend to outperform. So if we follow that, we're going to be generating more money to put back into the ecosystem. And also, let's trickle that one stage further down. Women are much bigger philanthropists by statistics. So we now fix the problem right at the bottom with more women doing more angel investing, which now fixes the problem. So actually, VCs could fix all of this, but we need to fix it from the top at the VC.
Sure. I'll let Basim finish, then I have something to talk about this point.
Yeah, no, absolutely. So VC money is critical. Angel money is critical. Grants are critical. Accelerators or incubators are critical. But we've realized in the region, the success rate of companies that have been funded by any of these mechanisms is relatively low. And mainly because of the challenges, the entrepreneur, the smartest, the core of the whole startup, the founder is not getting enough support enough handholding, enough support from the ecosystem, from the backers to enable them to become a success story. So we've realized the venture studio model is where you identify a space that you feel you can add tremendous value, it's impactful, it's social, and then you find the best founders in the world that can do that job. So the success, the minute that the milestones are not being achieved, then you know that's not going too far.
Absolutely. Now, we have also realized that private equity players like TPG, KKR, Bain Capital have made some strides in terms of positive social impact and investment. Obida, since you come from that background and you made a shift recently, do you think there's anything to learn from the PE players on sustainable impact investments?
Well, it's let's look at an example here. So if you take a traditional Arab family business, they've become successful in construction, for example. If you say, let's put some solar panels on top of all of your buildings, they'll turn around and say, well, who's going to wipe all the dust off them? Because this is not England and it doesn't rain. So the whole point here is with more technologies, with more innovation, with more early stage companies, we can satisfy these guys. So if I go back to him and say, well, here's a chemical you can put into your construction mix that absorbs CO2, he's going to go, okay, that sounds quite interesting. We can go back to these big private equity groups, these family-run businesses with a booklet of ideas that can satisfy their needs to make them more sustainable and tick their, really sustainability achievements.
I would like to know how's been your journey, because I'm sure when you talk to VCs, they are also looking for growth and scalability. How do you handle those kind of objections?
Thanks, Deepak. And it was really interesting to hear thoughts from Yusuf, which was coming in, of course, hearing back from both the panelists here. See, from the journey, let me start with where we stand today. We're a startup, 6 months old in Dubai, pretty young in sustainability tech side. We are in revenue today and got a good amount of sales leads to mature. Now, if I'll take back this 6 months old journey in terms of where we were already $250,000 down with all bootstrapping and running around with all the incubators in the world. And when we talk about the incubator space, if you look at it, I mean, this is again coming from a very, very personal experience just to fill the perspective here. it's when we talk about the incubators locally here still, what we believed is that still chasing the dream which the West world today is already advanced with, and they're looking at only in something around deep tech, something in those space as such, blockchain, AI, ML, all that aspects. But when we look at it, really where this region stands from a startup which is coming from a sustainability background, we have to cover a lot of ground on in reality as such. We are not there where the West is today when we talk about all sustainable practices. So we have to definitely, no matter how much we want to fast track it, we have to definitely track that path on the ground. And that's where we were. We were providing certain options and basically the products, which are more in terms of driving this behavioral change at the first place. When we talk about sustainability, but let's look at the timeline that we are looking at. I mean, the timeline which IPCC says that we've got 9 years to cut our emissions to half, and we are still discussing about something around deep tech and sustainability tech. So this is what our perspective was. Though we were chasing a lot of accelerators, incubators to start with, but the expectation was to have some startups in more on the deep tech side. Now coming back to basically all that incubation phase, then we moved on and started looking at more on the angel network. Now, angel and VCs together, we started exploring it, but the expectation, as we were saying, that from the VC was always to have investments which are probably, say, in a year's time or 2 years' time is going to be 15 to 20x of the investment of what the early investments they are going to make. But look at it, when we are in very early stages, providing from impact investment perspective and having expectations of 15 and 20x early on, it's a bit unreasonable. That's what, as a startup, we felt. That's what the perspective that we've gone through. But yes, the good part is that end of the day today, we are standing with 600K of fundraising already done in the initial 6 months itself from the angel network. So thanks to that.
Thank you, Vivek. As we said in the beginning of the conversation, that VC look for better returns than the average, and that's why they are in the growth companies. Bassam, you mentioned about milestones based. How do you measure impact investment? I mean, is there a framework? Is there any gold standards? I mean, and this question is open to all the panelists. So we start with you, Bassam.
So we start by looking at the founder and the concept itself and the venture that we're trying to build. And is that going to solve dramatic problems, major problems? What sort of problems are they going to solve? Are they going to resolve problems that deal with a specific group of people, or is this a problem-wide? Are we dealing with 84 million refugees that we're going to resolve that problem for, or is it going to be the 1 million children that will be born into refugees over the next number of years? So the minute that we identify that problem, we marry it with the SDGs that are out there to make sure that we're on track to achieve direct impact to specific targets. So that's kind of how we evaluate it. And then, of course, that's kind of the big dream. Now we got to scale it down to what are the baby steps? What is the next 100 days going to look like? How is this entrepreneur going to get established? How are we supporting that entrepreneur? When do we start paying the checks? And when do they need the money to actually grow their business? Of course, we are definitely driven by financials and performance, and that's got to always stay in the back of our minds. But we feel that if you're focusing on the right goals, then that's just the end product, the side product.
You kind of have to start simple. We'd ask all of our entrepreneurs, have you heard of the SDGs? And then you have yes or no. Do you map yourself to an SDG? Yes or no. To which indicator? Yes or no. And then we say, well, when you talk about this impact that you give, well, you save this much water, or you train these many teachers, or you remove this much CO2 from the environment, how do you assess that? Right? And then we kind of go through a bit of an audit process. And there are some standards, right, Sophia? There's a bunch of startup standards that teach people, startups, how to effectively protect themselves from greenwashing. Like to say, yes, I am an impact organization. Anybody can say that. It's like every product here in Dubai that says it's biodegradable. How do you really know? Do they put up a certificate in front of you? Right? They don't. So there's a lot of potential for people saying, we are an impact organization. And to prevent that, you kind of have to go through it. So, bit of a longer answer. I apologize for that. There are standards. They're hard to find. They're hard to use. Most people don't use them, right? Because they cost money. For a startup to be certified, it costs money. right? So, and I think there aren't, unless people on our side of the table, the money people are willing to say, hey, I'll help you. I'll spend that extra $10,000 for you to become certified.
We obviously focus on smart city and public safety, which can get quite technical at times. Now, when I was running around the UAE, I was speaking to founders, and there is capital available grants. You can have some of the VCs, even the sovereigns, the families looking at you, and there is capital available. But the one hard thing was selling the technology internationally. That's the one challenge we have in this market, is being known for good technology. I have trouble when I have an LP from New York say, well, we're going to be putting money into the UAE, and they say, well, can we not put it into the US because we get better valuations and more and more. So we look a bit into, like really deep into some companies and some technology. So at the moment, I gave an example, we're looking at a company that nobody would actually think is saving energy through the movement of data. So we all charge our devices, we live off our phones every day. And we charge things at home, we run power, we sit in front of computer screens. So our attitude is there are many ways to be more efficient in the movement of data, where it's stored. Everybody's talking about this metaverse, which I'm sure it can be used in certain applications, but at the same time, where the hell are we going to store all that information? And it's going to burn a lot of energy to do so. So we have to think about kind of the very key aspects of where we can make a difference, because we can't do so much at once. So in terms of, as I said, what we're focusing on, we're looking at companies here coming out of the universities who really can be quite specific. And then for us, our talent is we're very good at selling it to large corporates and governments globally. And that's our value add to the startups itself. Because as I said, the problem here is selling. I mean, it is what it is. If you can build the best products in the world and you can have all the money from the country here, but if you cannot sell it to an international market, it's quite a small consumer market here.
We look at all the big asset owners today, be it pension funds or the funds like BlackRock, right? So they are like completely, and they are global investors, and they have got a complete independent team working only on impact investments. The regulations come to that place where all these big VCs, they are very, very aligned with TCFDs, but that's where the graduation has to happen in this part of the world as well, where VCs need to really understand where the real impact is going to come, and the impact investment is going to be different from a regular any business as usual investments, where the return expectation will be completely different. So that's what at least we have realized, that that still that shift has to happen, because it's still not there. But when we look at few of, again, an example from our some initial clients, and they are into big time investments, when they are now looking at their carbon footprint to start with, which is like very first step to know that where you stand from your emissions perspective, the initial knee-jerk reaction was that I'm only concerned with my only emissions, not about my investee companies. But that's where the shift had happened. In just 3 months itself, the whole story changed, and now they're talking about opening up the whole set of investments that they have done, and wanted to know that what is their investees' carbon footprint, just to accommodate all of that and count all of that under their investment portfolio. So shift is happening, but I guess it's way too gradual to be able to probably cope up to the requirements, the timing requirements that we have today.
When we tackle long-term outcomes, and that's complex. Education is a long-term outcome, right? Disease is short-term outcome. Somebody's sick today, they could be, they get a vaccine and they're better tomorrow, they're protected tomorrow, right? So you could have financial metrics and milestones that begin to link to impact outcomes. And they could be in the same timeline. My opinion and my experience is that usually they're not, right? And that creates a big dilemma for VCs who have a very particular preference for return, for timeline, for a shorter timeline on return of their investment. But if they're going to look out for an outcome, right, and the timeline for that outcome, then there is going to be a divergence, right, in that. So I think they're being aware of that, because so that you do not push the startup to perform in a certain way without knowing that they might achieve one aspect first, but not the other.
we need, as an ecosystem, to support with bigger funding rounds from the VC, which we're doing. So funds are getting bigger and bigger and bigger, and you're seeing that now. We have Sequoia's Evergreen Fund, funds are, in the billions. So if we can do bigger rounds, that saves, having to go to those exits. And the second thing is startups need to remember that you can't keep relying on funding, right? You need to make and build a sustainable business that generates revenue and that will survive on its own. So if you're doing that, you'll stop that need to continue to raise and get stuck into that. And so focus on the money, focus on the revenue, focus on your margins. These are the things that you need to focus on as a startup to build a sustainable long-term business that doesn't need to be acquired, that can be the next large institution, that can IPO on its own.
If you're able to map the universe of agtech and see what works best within the region, what investments can be made with a mix of short-term and long-term results and returns, and then try to support the founders or identify founders in advance that can potentially even bring successful technologies from different markets or different areas around the world that you can replicate locally and partner up with those. So that kind of gives you a head start in having to reinvent the wheel every single time you want to start something. Now, the limitation on that, the Rocket Internet model, is that you're not being able to improvise or innovate enough in the region. But again, sometimes it's a balance that you need to measure. So within our strategy, we've got 80% of our funds is going to businesses or startups that we feel that we can build at a relatively fast pace, and then at the same time being able to have a larger impact, versus 20% that will go for longer term initiatives.
SDGs are designed for countries to report on. So even though we all can say, hey, my startup contributes to SDG, it doesn't report on the SDGs, right? So if we're going to say, I think to frame the question here would be, to what extent are VCs doing their part to make sure the SDGs are achieved by investing in alternative companies that help us achieve the outcomes delineated by the SDGs? I think that I think makes more sense, because then we can hold ourselves accountable and say, hey, we're investing in a company that makes oil companies more efficient or more lucrative. Does that, we as a VC would no longer support that type of innovation. Even though it is innovation, we would not support that because we don't believe in where that's going. So is that what we hold ourselves accountable? To the extent that VC money can support alternatives that help achieve the SDGs, we should have that, right? But the greater SDG question, I think that's governments, right? That's you and me. We're gonna solve the SDGs. Turn off the lights. Don't buy plastic. Do your things as a consumer. I think that those are the big answers to the big question. I think for us here is, are we ready to make ourselves accountable and say we will no longer invest in, no matter how exciting the technology is, that will create further gender inequality, further income disparity, further degradation of the environment, right? If we're ready to say that, then we can hold ourselves accountable and say, this is the VC standing up to say to the place that we have in pursuing the SDGs, we're in. I think we gotta get to that point, right? But to the point that we have a sphere of influence.